Welcome back. Now we are going to continue with our illustrative example class examples. Now we're going to be doing layaway or lay-by sales. Great, let's just go straight into the information. A Limited sells a bike for $3,000 to a customer on a layaway or lay-by sale. Ignore that. The date of this transaction or this agreement is 1st of January. Okay. The agreement is that the customer will pay 3 monthly installments of $1,000. So at the end of January, February, and March, you as A Limited will receive $1,000. The customer will not take delivery until the final installment. Therefore, this will definitely be a layaway. A Limited has a long history of layaway sales being consummated successfully. The requireds that I need you to do, please, are to prepare the journals for the following 2 scenarios. Firstly, A Limited will only order the bike from its supplier just in time to deliver upon the 3rd and final installment from the customer. So A Limited will get the bike from the customer from the supplier just before the customer comes to deliver and make the final installment. Okay. Then scenario 2 will be totally different, and in that scenario, A Limited has the bike in stock on the 1st of January, puts the specific bike aside in a storeroom ready for delivery once the customer makes the 3rd and final delivery. So first of all, let's go and do the journals. I want you to do the journals on the 1st of January and the 31st of January for me now. Push pause, give it a try. Assuming you've done the questions now, on the 1st of January, please remember, there is no revenue or other transaction. All you've done is enter into an agreement. Okay? If the customer does not make the 3 installments, you will not have to deliver the bike. Okay? So there is no journal on the 1st of January. However, on the 31st of January, you will receive the 1st installment. Do you recognize that as revenue? No, you don't. You will always debit bank with the cash flow of $1,000. What will you do with the credit? Well, I've just told you it's not revenue. Why? Because the 5 revenue recognition for sale of goods have not yet been met. Okay? There's no transfer of the risks and rewards. So what do? I will have a deferred revenue, an income received in advance. I will call that IRA, just abbreviation for income received in advance. And that is a balance sheet or financial position account, $1,000. Okay? If the customer stops doing the installments and does not come and fetch the bike, you will owe him back that $1,000. Now the 28th of February. I want you to think carefully here. You have received a significant deposit because now you've received the 2nd installment. Go ahead and do the journal. Will you recognize revenue or will it just be income received in advance? Give it a try, push pause. Assuming you've tried that again, you will obviously receive the $1,000, which is debit bank. The credit for $1,000, well, that's going to go to income received in advance once again. Okay. Why is there no revenue? Okay. If you remember from our earlier lectures, we said for layaway sales, okay, you will recognize revenue when the final installment is paid and delivery is made. There was an exception to that. It was if there's a history of such layaway sales being consummated, we've got that. If there was a significant deposit received, we've got that. 2,000 out of 3,000 is significant. But the third one was that the bike needed to be on hand and ready for delivery. Okay, in order to recognize revenue earlier. Well, the bike is not on hand, not identified, and therefore not ready for delivery. Therefore, I cannot recognize no revenue. Okay, so last journal for required 1, 31st of March, your 3rd installment, and delivery will take place. Okay, so 3rd installment, you will go debit bank, 1,000. That's correct, right? Now you've got to think about revenue recognition. Have the 5 recognition criteria been met? In terms of the illustrative examples, yes, it has, because all the installments and delivery has been made. So I will recognize all the revenue. Remember, this is revenue from sale of goods, so I must recognize 100% of the revenue on one specific date in profit or loss. That is 3,000 Rand going to profit and loss revenue. Well, now I've got the remaining 2,000. Where does that come from as a debit? Well, the last 2 journals, what was I doing? As I was receiving the money, I was crediting income received in advance. Well, there was a liability. Now that liability, the obligation has been settled. I will therefore debit income received in advance. Okay, so the trick here is figure out which date you will recognize 100% of the revenue on. In this scenario, it was when the final installment and delivery has been made. Okay, please remember there will also be a second journal in A Limited's books, which will be debit cost of sales, profit and loss, and credit inventory. I didn't give you enough information to do that, so I'm just going to put a little X. Okay, so that was the normal or standard layaway sale. Let's just quickly refresh for solution or required 2. A Limited has the bike in stock in this scenario on the 1st of January and will put it aside and have it ready specifically for delivery to the customer. This changes the ball game a little bit. Okay, so let's go. On the 1st of January, still no transaction. 31st of January, you will debit bank. You will credit what? Well, has a significant deposit been received? No, it's only 1,000 of the 3,000. Oh, that's first installment. Sorry, not second. So I will credit income received in advance, financial position, 1,000. Okay, now on the 28th of February, you'll receive the second installment. I want you to push pause and give this journal a try now. Remember, you have received a significant deposit. There's a history of sales being consummated. And the third one is the bike was on hand and ready for delivery. Give the 28th of February journal a try. Assuming you've pushed pause and you've given it a try, always start with your cash flows. When you have tricky journals, you'll debit bank 1,000. The point I want to make now is that you will recognize revenue on this date. Why? Well, we've met all the criteria in terms of the illustrative examples. We have a significant deposit, okay, which is more than 50%, eh? And the bike is on hand and ready for delivery. And it has been identified. So, therefore, I will recognize revenue in profit or loss. And remember, it's revenue from sale of goods. So, always 100% of revenue on a specific date, please. Credit the 3,000. Okay. Now, where's the remaining debit going to come from? Well, the remaining debit, I know I had an income received in advance account, financial position from the January journal, but that was only 1,000. Well, now I've recognized all the revenue. The remaining debit of 1,000, where do you think that will go? Well, that's going to go to debtors in financial position. Okay, it's a financial asset. A little tricky. Please make sure you understand the principle is that revenue gets recognized 100% on a specific date. Because we have received a significant deposit and the bike was on hand and ready for delivery, we will recognize all the revenue in P&L on the 28th of February, prior to the final installment and delivery being made. It's the exception. So then on the 31st of March, we're going to receive the third installment. That will be debit bank, credit. What do you think that credit is going to be? Take a second, write it down. Okay. Well, ladies and gentlemen, it's not going to be income received in advance. It's going to be the crediting of debtors that we created in the prior month. I hope you get a good grip to these layaway sales. They can be tricky. Understand the normal rule is recognize the revenue when the final installment's made and delivery is made. Okay. There is an exception if there is evidence of such sales being consummated or completed successfully, there is a significant deposit, and the bike is on hand, identified and ready for delivery, then you can recognize revenue earlier when those conditions are met. Okay, thank you.